Hi, I'm Joel, Director of Capitalised Business Finance. In this video, I'm going to be talking briefly about cash flow. What is it and how does a cash flow problem occur? And I'll introduce invoice financing as a cash flow management tool. But firstly, just to let you know who I am, I'm an independent business financier who's helped many businesses achieve complete cash flow control through tailor-made financing solutions such as selective invoice financing, supply chain and trade finance, and short-term business loans. Over the years, I've learnt a lot and seen many business owners make mistakes that have cost their business dearly. Mistakes that can be avoided by some basic understanding of how this industry works and what to look for when searching for a business financing facility. One of my goals is to provide the knowledge to empower other business owners to achieve success. The more positive, motivated, happy and successful business owners we have in our society, the better our lives will be. I'm also a property developer and investor, and I'm passionate about helping good, honest people succeed. I don't come from privilege. My parents came to our country with one suitcase of clothes and couldn't speak English. I'm self-made, and from personal experience, I'm a firm believer that everyone has the opportunity to be whoever they commit to be, but they must commit and put in the effort to succeed. So, when it comes to business, what does having a cash flow problem mean? Well, quite simply, it's when you're waiting for your customers to pay you while your creditor payments are overdue. That is, your incoming payments may be a few weeks away, but you need to pay your wages or rent or fuel bills or make repairs this week. This is where the saying, profitability is one thing, but cash remains king, comes from. Cash flow, the incoming and outgoing of cash, is the lifeblood of your business. Without cash flowing, you can't run a business. In fact, the purpose of cash, the reason for it is to exist, is to flow and grow. When it flows, it creates change. From movement of goods to creation of goods to provision of services, our society lives and breathes when cash is flowing. In Australia, 40% of business failure is due to poor cash flow management. So taking the time to understand how you can control your cash flows is imperative to your success. Now, when it comes to actually experiencing a cash flow problem in your business, it may appear as though you just need more money. Sure, money would bridge a gap, but does it solve an underlying problem? Before answering that question, there are two definitions that we need to understand. What is money and what is an invoice? A quick Wikipedia search shows the following. Money is any item of verifiable record that is generally accepted as payment for goods and services and repayment of debts. Money is a store of value. In my words, money simply represents value that you have created, for example, selling an item or performing a job, which you can decide when and for what you exchange that money, usually the purchase of other goods or services. An invoice is a commercial document issued by a supplier to a buyer relating to a sale transaction and indicating the products or services and the agreed price and the date that the supplier had provided to the buyer. In my words, an invoice simply states very clearly that a buyer is due to pay an amount of money to a supplier at an agreed future date. Why do we have invoices? Let's look at the sequence of events that many businesses follow. 1. They perform a task. They deliver a product, provide a service that their customer has asked of them. 2. When they have finished the task, the customer is expected to pay them. 3. Often, and this is relatively industry specific, the customer doesn't have the cash to pay them. This is usually because the customer's own customers haven't paid. Consider, for example, if you contracted a builder to build you a house. The builder has materials and workers to pay in order to build your house to certain stages, after which you inspect the quality of the work and if you're happy, pay the builder. Nobody should expect you to pay for a service or product that's not delivered, which is the case for the builder, but he also has to pay wages, materials to build your house. Now, this is how cash flow problems can arise. They're not limited to the construction industry. Any business with extended customer terms can experience cash flow problems. 4. Let's get back to the sequence. Your customer doesn't have the cash to pay you, so you issue them with an invoice. Now, let's get this understood. Your customer can't pay you today, so they demand credit by asking to pay you later via an invoice. Now, this is important. You have created the value and now your customer is asking you to bankroll their business. They've either exhausted their cash reserves or simply want you to finance their business for a period of time. Either way, they are demanding that you carry the risk of not receiving cash when your job is complete. What's the risk? Plenty. Not just the risk of your customer's business failing before you get paid, but the risk to your business through the financing, the time delay, either through direct financing cost or through lost opportunity from not having the funds available to seize that next big contract, or not having the funds to increase production. This is where time is money impacts businesses. Having said that, you need to recognize and understand when businesses extend their payment terms to you, those businesses have created income opportunity for you through their business. So in a way, you're partnering with them in a project. With this in mind, the use of extended payment terms makes sense. You can see from both supplier and customer side how extended payment terms come about and why they exist. One last thing to mention is that in some industries, standard contracts will contain a clause noting that a subcontractor or supplier cannot assign or subcontract any portion of the agreement without the written consent of the buyer. This is designed to allow the customer, the buyer, to maintain control over who is providing the supply. That is, it limits the ability of a supplier subcontracting their supply to another party who the customer may not want. The clause is broad, and at the moment it includes the invoices a supplier issues to a customer. However, when managed properly, we've never had an issue with this clause. It's important to understand what money is and what an invoice is, how they are created and what they represent. Like money, an invoice represents value and debt. That's the promise of money at a later date. As such, it's a tradable commodity. That is, invoices are assets to a business that can be turned into cash. In fact, for many businesses, their outstanding invoices, their accounts receivables, is one of their biggest assets. Having the ability to turn these assets into cash goes a long way towards helping solve cash flow problems. So yes, invoices can be financed, but not all of them. I have other posts that delve into how invoice finance works and what the benefits and limitations are of the different types of invoice finance on the market. But for now, yes, you can obtain finance on some of your customer invoices. In my experience, when utilizing invoice financing as a business cash flow tool, there is one question I often hear which shows a lack of confidence on part of the business owner. That question is, what will my customers think if I finance an invoice? The fear is that the customer will think that the supplier business is not strong. This is a result of very low regards of debtor finance due to some poor industry practices that occur even today that often result in client business stagnation. Too many businesses have been burnt by very low quality invoice finance products, resulting in an industry image of lender of last resort. Again, I talk about this in more detail in other posts. I have two answers to the "what will my customers think" question. Firstly, it is often the case that it's mainly growing businesses that encounter cash flow issues, simply because their input costs increase and there is a delay in receiving the increased income. As a business owner, you shouldn't be utilizing an invoice financing facility unless your business is growing and the facility is accelerating that growth. Using invoice financing means that your business is growing and that you are being financially supported through that growth. Your business is stronger thanks to invoice financing. In fact, many businesses are utilizing supplier financing facilities, one reason being to strengthen the supplier businesses in order to strengthen their supply chain. I talk about supplier financing in other posts. If your customer doesn't understand the benefits of your business receiving finance, then a brief discussion with them will help. Perhaps they would like to understand supplier finance. After all, some of their suppliers are utilizing invoice finance. My second answer is to highlight who's demanding credit and asking for bankrolling of their business. The debt lies with your customer. Your customer should not dictate to you what benefit you realize from your efforts. Imagine if an employer dictated to each employee where their wages could and couldn't be spent. What your customer thinks is not that important that it should slow your progress to success. So, to summarize, the role of cash in society is to flow. Without flow, it creates nothing and is useless. The flow of cash is the lifeblood of any business. The faster it flows, the more money you can make. Again, that's covered in more detail in other posts. Cash, money, is a store of value, and you decide how and when you realize that value. An invoice represents the promise of cash at a future date. It's a "you owe me" document, and as such, it's a tradable commodity. Invoice financing is a facility that converts your business-to-business invoices into cash, and it's typically utilized by successful, growing businesses. So I hope this information has been of benefit to you, at least in understanding your position in the supplier-customer relationship. We delve into more details on alternative finance, invoice finance, and types of invoice finance in other posts. So be sure to check them out so that you have the knowledge needed when searching for a suitable financing facility for your business. If you have any questions or comments, leave them in the section below. Thank you.